I just got paid my largest dividend ever. That was $1,966 all in one day. And these came from two undervalued dividend stocks that I have been buying up over the past few months. That's Hess Midstream, ticker symbol HESM. They paid me $1,657. The other was from MPLX, which paid me over $308. I reinvested both of these, buying more shares, increasing my dividend snowball. After 5 years of dividend growth investing, that was by far my highest payment. And it really starts to make the passive dividend income feel real. I'm starting to build up sizable stakes in businesses which pay me a portion of their profits. I continue to add new money to this account, reinvest my dividends, and benefit from the compounding of dividend growth. Both MPLX and HESM grow their dividend payments every year. HESM, as an example, has been growing their payment every single quarter, and that's a 5-year compound annual growth rate of 11.31%. They just did another 2.4% increase. MPLX has been doing annual dividend increases, and they just did another 12.5% raise. That is now back-to-back 12.5% increases. For high-yield dividend stocks, this is very high growth. When I get a large dividend payment like I did today, it really starts to solidify that dividend stocks can be a great foundation towards financial independence. This is passive income that's paid to you as a shareholder, and you don't have to sell your ownership stake in the company. In fact, while you're young, you can reinvest it to buy more assets, whether that's the same stock or another. Today, I'll give you an updated look at these two undervalued dividend stocks and why I'm still buying more. Plus, if you stick around to the end, I'll share future projections of my current stock portfolio and how it could compound over time, both in terms of dividend income and value, if I add no new money. And it really highlights the importance of building up your investments while you're young and getting some momentum on your side so that you can let the snowball roll. With that said, let's roll the intro and get into the video.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'll be using dividenddata.com, which is the research platform I built to help me track my investments and find better stocks. If you like what you see and want to follow along, it's all available at dividenddata.com. Our Black Friday sale is now live, which is the best deal we ever offer. You can lock in 50% off annual memberships. This is really just an investment in your investing strategy. If the tool helps you find just one better stock, then it way more than pays for itself. I know it helps me a ton. Heck, that's why I made it in the first place. So if you want to check it out, link in the description and pinned comment of the video. So before I get into the two undervalued dividend stocks, I'll just give you a brief overview of my dividend portfolio. It's just over $275,000, and that's before including the dividends I was just paid today. Those are going to be reinvested, although that usually takes at least a day to be processed by your brokerage. So really the total value is more like $277,000. Overall, this account pays me $11,500 in annual dividend income. That's $2,800 a quarter, $958 a month, $31.50 a day, and $1.31 an hour. And this is my largest dividend month by far because I built up those high yield midstream oil and gas stocks. And I think these will really power the growth of my dividend income over the long term. My other months are lower, $386. That's with Google, Microsoft, Visa, and ExxonMobil. And then $500 from the Altria Group, ticker symbol MO. These are all quarterly payers, so there's a 3-month rotation in the dividends paid. Both my dividend income and yield on cost has grown a ton by adding HESM and MPLX. My overall yield on cost is 6.59%, and from reinvesting dividends, that's up to 7.04%. And when I say that, this is kind of a custom metric that I developed. That's because when you reinvest dividends, it's really a part of your return. That's part of your profits as an investor. So with the Altria Group as an example, I have 124 shares from reinvesting dividends. And this is part of what helps create that snowball effect because you reinvest the dividend to buy more shares, increasing your dividend income and ownership stake in the company. So both your value and future dividend income are now higher. That allows you to reinvest more, and it creates this virtuous cycle of growth. That is assuming you're investing in a high quality company, which is growing. Another great example of this for me was ExxonMobil, ticker symbol XOM. I bought that company 5 years ago, and I've gotten 34.3 shares from dividend reinvestment. And my yield on cost is very high and even higher from reinvesting dividends, despite the fact that the current yield is so low at 3.4%. And yes, this was by far my highest month of dividends. And I'll give you a little bit of an idea of the dividend snowball at work with my latest HESM dividend. So I'm taking that $1,657 and I reinvested all of it. I don't know the exact numbers yet, which is why it's not added into my system. But let's assume I reinvested at $33 a share, which is about what it was today. That will buy me 50 more shares of HESM. The current forward-looking annual dividend payment for HESM is $3.02. So that will increase my dividend income by another $151. And I'll be using that next time to buy even more shares. This process will continue and only get more powerful because HESM keeps raising their dividend payment as well. This is an important factor to consider because most people, when they're talking about investments, they're not even really factoring in the dividend income. They only think about the stock price. But dividends are a real part of your return. After all, when you're investing, the goal is total return. Let's take a look at HESM as an example. I've been buying a ton of it because they've drawn down a ton. They're down 23% from their all-time high. If we type in HESM dividend yield into my AI analyst on dividenddata.com, you can see this is one of the highest starting dividend yields of the past 5 years. And we are currently at the highest of the past 3 years. So the stock's down a ton. I personally think it's undervalued. I've done full stock review videos in the past. But the reason why I'm bringing that up is because we're going to look at the historic performance of HESM. So based purely on stock price over the past 3 years, it's only gone up 16.6%. That's a 5.3% compound annual growth rate. Not very good. But even with the poor stock performance, if we go to the total return in that time is 47.1%. That's a 13.7% compound annual growth rate. So with HESM, a big part of that total return comes from the dividend. This is a hidden part of investing that you're not seeing a lot of the time. And back in August, that total return would have been 82% before this recent sell-off. The 5-year price return is 92.6%. That's a 14% compound annual growth rate. The 5-year total return is 183% or a 23.2% compound annual growth rate. So in that time, a $10,000 investment would have grown into $28,320. HESM just reported earnings, and I think it was pretty good, so I'll probably do an updated full stock review video on it soon. But they reaffirmed their expectations for dividend growth, targeting at least 5% through 2027, targeting at least 5% annual growth through 2027. And by the way, they've had that target in all these past years where they were hitting 10% a year. If we look at the stock performance for MPLX, it tells a similar story. The 3-year change in price is 57.5%. That's a 16.3% compound annual growth rate. But the total return is 102%. That's a 26.5% CAGR. The 5-year change in price is 159%. That's a 21% CAGR. The total return is 310%, which is a 32.6% CAGR. So again, dividends play a large factor in the total return for these high yield companies. Now, it should be noted that past performance is not a guarantee of future performance, and especially during that 5-year mark. That was during the end of 2020, where a lot of these energy stocks were deeply undervalued. Your returns definitely depend on the price that you pay. As an example, in 2015, the valuations on these midstream oil and gas pipelines were not good. And if you had bought at the top back then, you would only have a 60% total return, which would be a 4.7% CAGR. But this is why it's important to do your research when you're investing in companies. If you were buying MPLX back then, you would have known that the dividend back then was 2.5 times less than it is now, and you'd be paying nearly twice the current stock price. So instead of being a high cash flow, low multiple company, trading at an attractive valuation and a high dividend yield, you would have been buying MPLX at a 2% dividend yield. So overall, I'm excited about how my dividend portfolio will continue to grow over time, and I plan to regularly invest new money. I do monthly portfolio updates and letting you know what my new buys are. But what if I didn't invest anything? I've already built up a good financial foundation. So let's project out how this portfolio would grow over time. I'm going to be using this calculator I made. It's meant for individual stocks. but you can kind of hack it a little bit by assuming your whole portfolio is a stock. So I'm imagining it as I'm buying a share of my current portfolio and projecting that forward. The key assumptions here are 8% dividend compound annual growth rate going into the future and 10% stock price compound annual growth rate. And the reason why I picked that is I have some higher growth companies, whether it's Microsoft or Google, and then I have these higher yield companies with pretty good dividend growth, but you should expect less stock price appreciation. And the key assumption here is that we're reinvesting dividends. So over the span of 35 years, this account is projected to be worth $23.3 million, and it could be paying me over $400,000 a year of dividend income. And a lot of that is because of reinvesting dividends. In fact, the difference between reinvesting dividends and not, it's the difference between $8.9 million and $23.3 million. And the reason is you're delaying the immediate gratification of taking those profits and potentially using it to fund your lifestyle. And you're reinvesting it into buying more assets. And this is a compounding effect, as I mentioned earlier. It's why the number one factor when you're investing is time. And you're investing now so that you can get momentum on your side. With that said, I hope you enjoyed the video. Make sure to subscribe to the channel for future portfolio updates. And if you want to use the stock research tool I showed throughout, it's all available at dividenddata.com. We have our Black Friday sale going on right now. It's the best time to join. If you want the deal, click the link in the description and pinned comment of the video. With that said, thanks for watching, and I'll see you in the next one.